Let me get your initial reaction. Of course, this is something that, the banks won't have much of a choice in. They're being roped in as part of the broader effort to try and support broader economic growth. How much of a hurdle is this to profit margins and future profitability here?
Right. We did highlight at the beginning of the year that margin pressure is probably one of the biggest challenge for banks this year. Asset quality risk aside, the fact that housing transactions, for example, so far year to date has still been quite weak, so that's hurting mortgage loan demand. In addition to mortgage prepayments, but compensating for that, banks have been growing in areas such as the green sectors, inclusive finance, for example. So overall, there's still a bit of loan growth that's holding up the profitability, but sure enough, we have seen declines in net interest margins.
At the end of the day, so the government is not tapping into its own balance sheet directly to households, right? But this issue of the fact that this is still, income transfer one way or another, will the banks eventually in China have to be recapitalized?
Well, the fact that they are still generating positive earnings growth, even in this very difficult environment, I think part of that is attributable to the risk reduction effort as part of the regulatory tightening that the sector has undergone in the past 5 years. So as a result, while there's still a lot of headwinds ahead, but the bank's intrinsic credit profile has actually improved over the years because of these regulatory tightening and reduction in off-balance sheet financing, for example. So at this point, I think it's too early to talk about recapitalization, especially for the largest banks, although pressures do exist in some of the smaller lenders.
How many systemically important financial institutions does China have? And could problems at one place really spark a contagion? Although you're saying that it is still too early talking about recapitalization, but at what point do we start to gauge that there might be a systemic problem?
There are 19 domestic systematically important banks in China, and they roughly make up about 60% of system assets. It is the remaining sort of 30 to 40% of the system that we are usually more concerned about, because these are typically the smaller regional lenders that operate in weaker provinces. So unsurprisingly, more of the credit issues that we see for the sector right now, whether that's deposit competition or whether that's exposure to property and local government sectors, those problems are making the smaller lenders most vulnerable within the sector.
So, Grace, if we do in fact get this announcement on rates on existing mortgages and deposits being cut, what will be the impact for these big banks in terms of margins and pressure, depending on how much of a cut we'd see? Also, are we expecting most of the loan book to be refinanced, or is it just a few people that would actually go ahead and do that?
Yeah. In the event that there is a uniform reduction in mortgage rates, it will be the larger banks that will be hit hardest, because they have the largest relative exposure to mortgage loans. Generally speaking, for the big four banks, mortgage loan makes up about 20 to 30% of their loan book, compared to generally less than 20% for the mid-sized banks. So a mortgage rate reduction will impact the largest banks more. That said, we do expect that there would be potential mitigating factors. For example, reduction in deposit rates to help mitigate that margin pressure. But generally speaking, we do expect margin pressure to persist in the second half of the year and into 2024, because you will have the lagged impact from the previous loan prime rate reductions that will flow through into next year's earnings.